Alert! Silver just surged 155% while you were sleeping. Copper up 40%. Platinum up 130%. Palladium up 75%. But silver crushed them all. What just happened? Between September and November 2025, silver executed the most aggressive rally in modern history. A 50% surge in just 2 months. This wasn't normal market behavior. This was a convergence event. The gold to silver ratio hit 104 in May 2025, the second highest reading in recorded history. Then something broke, the ratio collapsed, silver exploded, and the world's financial landscape changed forever. What I'm about to show you isn't theory, it's data, it's patterns, and it's happening right now while mainstream media focuses on everything else. Pay attention, because this changes everything. Let me show you something extraordinary. Silver's performance over the past year eclipsed virtually every other asset on Earth. Not stocks, not bonds, not even Bitcoin during its best runs. We're talking about a 155% gain in a single year. To put that in perspective, if you invested $10,000 in silver, you'd be sitting on $2,500 today. That's life-changing money. But here's what makes this truly remarkable. This wasn't a random pump. This was a multi-layered confluence of market conditions that created what analysts call a perfect storm scenario. Silver didn't just outperform, it dominated. It crushed copper's 40% gain. It destroyed platinum's 130% rally. It left palladium's 75% surge in the dust. Why? What made silver different? The answer lies in understanding the precise moment of convergence. Multiple forces kicked in simultaneously, each one powerful on its own. Combined, they created an unstoppable momentum that's still building today. Between early September and early November 2025, silver vaulted to a rally of almost 50% in just 2 months. Think about that. A 50% gain in 60 days. That's the kind of move that creates generational wealth. This meteoric rise was powered by forces most investors completely missed. While everyone was watching stocks and crypto, the real wealth transfer was happening in the precious metals market. Understanding this moment requires a deeper look into both positioning and underlying market psychology. The technical setup, the fundamental narrative, and the broader geopolitical shifts driving capital flows. Here's where things get technical but critically important. The gold to silver ratio is the key to understanding what just happened. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Over the last 50 years, this ratio has averaged approximately 67. That's the historical norm. That's what equilibrium looks like. But something changed dramatically over the last 6 years. The average ratio over the last 6 years shot up to almost 84. That's a massive divergence from the historical mean. Why? What caused this dramatic shift in the relationship between gold and silver? The economic panic related to the COVID-19 pandemic caused a rush into what is often viewed as the world's safest asset, gold. Fear drives people to safety, and gold is the ultimate safe haven. But even as the economic stress subsided, another compelling tailwind for gold emerged. This is where the story gets really interesting. This is where geopolitics enters the equation. Global central banks accelerated their stockpiling of gold as an alternative to holding reserves strictly in US dollars and treasuries. This wasn't a small shift. This was a tectonic plate movement in global finance. For perspective, in 2017, 64% of the world's reserves were held in dollars. That number has dwindled to approximately 57%. That's a 7 percentage point drop in just 8 years. This shift appeared to accelerate in relation to what some countries viewed as a heavy-handed approach in how the US dealt with Russia following its invasion of Ukraine. The US orchestrated a freezing of Russian dollar-denominated assets. They blocked Russia from participating in the global SWIFT payment system. These were powerful financial weapons that got the world's attention. Many will make the reasonable argument that these actions were necessary. But economist Thomas Sowell said it best. There are no solutions, only trade-offs. Every action has consequences. Every decision creates reactions. In this instance, the trade-off was a global attempt at de-dollarization. Countries around the world started asking themselves, if the US can freeze Russian assets, could they freeze ours? Better diversify. Now, the word attempt was carefully chosen here. There's a pervasive belief that there is no legitimate alternative to the safety and stability of dollars, that these de-dollarization attempts may ultimately fail. But regardless of whether they succeed, the attempt itself drives behavior. And that behavior was massive gold buying by central banks. Gold purchases by central banks hit record levels in recent years. It's also worth mentioning that US trade policies probably gave additional motivation for countries to seek a substitute to the dollar. Tariffs, trade wars, economic nationalism, all pushing the same direction. The net result was a huge rally in gold that pushed the gold to silver ratio up to a 4-year high of 104 in May of 2025. Let that sink in. This marked the second highest ratio in recorded history. the highest being the 120 reading in the immediate aftermath of the 2020 pandemic. We're talking about extreme, historically unprecedented levels. An additional tailwind to gold's rally was a growing belief that the current explosive levels of U.S. deficit spending could have a significant negative impact on the dollar's value. This debasement trade has been a tailwind to all hard assets: gold, silver, commodities, real estate, anything that isn't paper currency. But gold was the biggest beneficiary because of additional geopolitical factors. Now here's where the story takes a dramatic turn. It's been a noticeable characteristic of the gold-silver relationship throughout history. In times of stress, the market's knee-jerk reaction is to rush into gold. Gold moves first. It's the safe haven. It's what everyone knows. It's what central banks buy. It's the headline metal. But then something predictable happens. Silver catches up. Later, as the dust settles, silver often has aggressive catch-up moves. Not gradual, not slow, aggressive, violent. The kind of moves that create incredible wealth for those positioned correctly. Silver's performance in late 2025 was no exception to this historical pattern. Although gold's magnetic pull on silver set the ball in motion, the silver trade also had its own accelerant. This is crucial to understand. Silver didn't just follow gold higher. It had its own fundamental drivers that fueled the meteoric rise. It had its own narrative that captured investor imagination. It's often the case that an asset will begin a move that's initially based on technical factors. The gold-to-silver ratio was stretched. Mean reversion was inevitable. That's the technical setup. Once that move is established, the fundamental narrative emerges and provides fuel for subsequent legs higher. This is exactly what happened with silver. The narrative crystallized at the perfect moment. In silver, the narrative involves structural deficits against ever-increasing demand for electrification. This isn't a cyclical story. This is a structural multi-decade megatrend that's just beginning. The world is electrifying everything: electric vehicles, solar panels, advanced electronics, AI data centers, crypto mining operations. All of these require massive amounts of silver, and there's not enough supply. Let's talk about the elephant in the room. Over the last 2 years, the prospect of evolving AI technology has been a dominant driver of equity market returns. Everyone knows AI is transforming the world. Everyone knows tech stocks are rallying on AI hype. But what's only recently been talked about is the massive amounts of energy needed to power AI. Data centers required to support new AI technology consume extraordinary amounts of electricity. We're not talking about incremental increases. We're talking about exponential growth in energy demand. This narrative has been an additional tailwind for the industrial metal space: metals used in electrical infrastructure, metals used in energy generation, metals used in power transmission. Copper rose 40% in 2025 on this thesis. Copper is essential for electrical wiring. The electrification of everything means unprecedented demand for copper. The market recognized this early. Platinum jumped over 130% on the same theme. Platinum is used in various industrial applications, including hydrogen fuel cells. The clean energy transition requires massive amounts of platinum. Palladium was up over 75% as electrification and industrial demand surged. Palladium is critical for catalytic converters and various industrial processes. Demand is outstripping supply across the board, but silver far outpaced them all over the same period. Silver gained almost 155%. Why? What makes silver special compared to other industrial metals? Silver is unique. It's the most conductive metal on Earth. It's essential for solar panels. It's critical for electric vehicle electronics. It's required for advanced semiconductor manufacturing. Every solar panel contains significant amounts of silver. As the world transitions to renewable energy, solar installations are exploding globally. Each new solar farm consumes tons of silver. Electric vehicles use 25-50 grams of silver per vehicle. Multiply that by millions of EVs being produced annually. The numbers become staggering. This is structural demand that won't disappear. AI data centers require advanced cooling systems and electrical infrastructure. All silver intensive. Crypto mining operations need high-performance computing equipment. All silver intensive. The demand keeps growing. Here's the problem. Silver supply is constrained. Mines are struggling to increase production. Many silver deposits are becoming depleted. New discoveries are rare and expensive to develop. Above-ground inventories are being drawn down by industrial consumption. Unlike gold, which sits in vaults, silver is consumed in products that can't easily be recycled. It's gone forever. When you have explosive demand growth meeting constrained supply, prices have only one direction to go: up. And that's exactly what we're seeing in real time. Let's step back and look at the complete picture. Silver's extraordinary performance isn't just about one factor. It's about timing. It's about multiple powerful forces converging simultaneously. The setup from an extreme gold to silver ratio provided the springboard. The ratio hit 104 in May 2025. That was the second highest in recorded history. Mean reversion from that extreme was inevitable. When the ratio is that stretched, professional traders know what comes next. Silver catch-up trade. It's happened before. It'll happen again. The setup was perfect for those paying attention. The fundamental story of structural supply deficits and surging industrial demand provided the fuel. This wasn't just technical positioning. There were real, powerful, fundamental drivers supporting the move. And the broader market psychology around de-dollarization and hard assets provided the conviction. Investors weren't just buying silver for a quick trade. They were buying for the long term. When multiple elements converge like this, the resulting move can be significant. We're not talking about 10% gains. We're talking about 50% moves in 2 months, 155% gains in 1 year. This is what market professionals call a perfect storm. Every factor aligning, every catalyst firing simultaneously, every trend reinforcing the others, creating unstoppable momentum. Think about a trader looking at this setup in September 2025. The gold to silver ratio was stretched. Electrification demand was accelerating. Central banks were buying gold. De-dollarization was accelerating. All signs pointing in the same direction. All indicators flashing green. All fundamentals aligned. The only question was, how big will this move be? The answer turned out to be bigger than anyone imagined. The professional money moved first. Hedge funds, commodity trading advisors. Smart money recognized the setup and positioned accordingly. Then the momentum traders piled in. Then retail investors followed. Each wave of buying pushed prices higher. Each new high attracted more attention. Each breakout triggered more buying. The feedback loop became self-reinforcing. Classic bull market dynamics. Let's dive deeper into the industrial demand story because this is absolutely critical to understanding silver's long-term trajectory. This isn't a temporary spike. This is a structural shift. Solar panel installations are growing exponentially globally. China, United States, Europe, India. Every major economy is pushing renewable energy. Every solar panel requires silver, lots of it. The typical solar panel uses approximately 20 grams of silver. That might not sound like much. But when you're installing millions of panels annually, the numbers become astronomical. Global solar capacity is expected to more than triple by 2030. Triple. That's not a forecast. That's based on current policies and announced projects. The silver demand is already baked in. Electric vehicle production is accelerating faster than most people realize. Legacy automakers are transitioning their entire fleets to electric. New EV companies are scaling production rapidly. China is leading the charge. Each EV contains 25-50 grams of silver in various electronic components. As EV production ramps from millions to tens of millions of units annually, silver demand multiplies accordingly. 5G infrastructure build-out requires massive amounts of silver. Every 5G tower, every advanced smartphone, every Internet of Things device, all silver intensive. And we're just beginning the 5G revolution. AI and data center expansion is perhaps the most explosive demand driver. These facilities require advanced cooling systems, backup power infrastructure, and sophisticated electrical distribution networks. All require significant silver content. The scale of AI infrastructure investment is staggering. Tech giants are spending hundreds of billions on new data centers. Microsoft, Google, Amazon, Meta, all building massive AI computing facilities. Each facility consumes tons of silver in electrical infrastructure alone. Multiply that by hundreds of planned data centers globally. The demand is unprecedented in human history. Crypto mining operations add another layer of demand. Bitcoin mining, Ethereum operations, other cryptocurrencies, all require high-performance computing equipment that's silver-intensive. This demand continues growing. Medical applications for silver are expanding. Silver's antimicrobial properties make it valuable in healthcare settings. Medical devices, antibacterial coatings, advanced wound care, all using more silver. Water purification systems increasingly rely on silver. As global population grows and clean water becomes scarcer, silver-based purification technology is seeing increased adoption. Another structural demand driver, the military and defense sectors are major silver consumers. Advanced weapon systems, radar equipment, communications technology, all require silver. Defense budgets are rising globally, more demand. Here's the critical point. This demand is structural, not cyclical. It's not going away when the economy slows. It's embedded in the technological transition society is undergoing. Now, let's talk about the other side of the equation. Supply. Because while demand is exploding, supply is struggling. And that's creating a crisis that most investors don't yet understand. Silver mining is complex. Most silver is actually produced as a byproduct of other mining operations. Copper mines, zinc mines, lead mines. Only about 30% of silver comes from primary silver mines. This means silver supply doesn't respond to price signals the way most commodities do. You can't just mine more silver when prices rise. Production is tied to other metals. When copper production slows, silver production slows. When zinc mines become uneconomical, silver supply drops. This creates supply inflexibility that exacerbates price volatility during demand surges. Many major silver deposits are becoming depleted. Mines that have been producing for decades are seeing declining ore grades, more energy and resources required to extract less silver. New silver discoveries are rare. The easy deposits have been found. What remains requires advanced technology, higher costs, and longer development timelines. Supply growth is anemic. Environmental regulations are making mining more difficult and expensive. This is appropriate from a sustainability perspective, but it means less new supply coming online to meet growing demand. Political risk in major silver-producing countries adds uncertainty. Mexico, Peru, Chile, Bolivia all face political instability that can disrupt production. Supply chains are vulnerable to geopolitical shocks. Above-ground inventories are critically low. The silver available for industrial use is being drawn down rapidly. Exchange inventories have fallen dramatically. Visible supply is disappearing. Unlike gold, silver is consumed in industrial applications. It's not sitting in vaults waiting to be sold. It's embedded in solar panels on rooftops, in EVs on roads, in phones and pockets. Recycling rates for silver are relatively low compared to gold. You can't economically extract silver from old electronics. The quantities are too small. The cost's too high. It's effectively gone forever. This creates a one-way demand dynamic. Every year, industrial consumption permanently removes silver from available supply. The above-ground silver stockpile shrinks. The deficit widens. Industry analysts estimate silver markets have been in deficit for several consecutive years. More consumed than produced, deficits filled by drawing down inventories. But inventories are finite. At some point, inventories run low enough that price has to rise significantly to ration demand. We may be approaching that inflection point now. That's what the 155% surge might be signaling. The question now becomes whether this rally represents a permanent repricing of silver's value in an electrified, AI-powered world. Or is this an overcorrection that will reverse? Given the persistent nature of the supply-demand imbalance, the case for sustained strength seems compelling. The fundamentals aren't weakening, they're strengthening. Demand continues accelerating. Supply remains constrained. The continued build-out of energy infrastructure guarantees years of strong silver demand ahead. Solar installations, EV production, 5G deployment, AI data centers, all require multi-year construction timelines. This means that demand is locked in. Companies have made investment decisions, projects are underway, purchase orders are placed. The silver consumption is inevitable regardless of short-term price moves. But, as with all markets, nothing moves in a straight line forever. Pullbacks are normal. Consolidation is healthy. The question is, are we in a pause or reversal? The evidence suggests this is a repricing, not a bubble. Silver's industrial consumption is real. The supply deficit is real. The electrification trend is real. These aren't speculation. These are facts. Compare this to previous silver rallies driven purely by speculation. The Hunt brothers' manipulation in 1980. The post-2008 financial crisis spike. Those were driven by sentiment and leverage. This rally is different. It's supported by fundamental industrial demand that didn't exist in previous cycles. The world wasn't electrifying in 1980. Solar wasn't mainstream in 2011. AI didn't exist. Today's demand drivers are structural megatrends that will play out over decades. This isn't a 3-year commodity cycle. This is a 20 to 30-year technological transformation of human civilization. Silver is essential to that transformation. There's no substitute for silver in many applications. It's the most conductive metal, the most reflective, the best antimicrobial, irreplaceable. When an asset becomes essential to a major technological shift, its value gets repriced. Think lithium with EVs. Think rare earths with technology. Silver with electrification follows the same pattern. The market is beginning to recognize that silver isn't just a precious metal for jewelry, it's a critical industrial commodity for the 21st century economy. That recognition drives repricing. Professional analysts are revising their long-term silver price targets upward, not by 10 to 20%, by 100 to 200%. They're modeling structural deficits extending years into the future. The math is compelling. Let's return to the de-dollarization theme because this is a massive macro driver that amplifies everything else we've discussed. The global monetary system is shifting beneath our feet. For 80 years, the US dollar has been the world's reserve currency. This gave America extraordinary privileges, the ability to run deficits without consequence, the ability to print money with impunity. But that system is showing cracks. The weaponization of the dollar against Russia made every country reconsider their dollar dependency. If it can happen to Russia, it can happen to anyone. Countries are diversifying reserves. They're accumulating gold. They're exploring alternative payment systems. They're reducing dollar holdings. This is happening quietly but consistently across multiple nations. China and Russia are settling trade in their own currencies. BRICS nations are developing alternative financial infrastructure. The petrodollar system is weakening as Saudi Arabia accepts other currencies. This de-dollarization doesn't happen overnight. It's a gradual process that could take decades. But the direction is clear, and the implications for precious metals are profound. When countries lose confidence in paper currencies, they turn to hard assets, gold for central bank reserves, silver for industrial applications and store of value. Both benefit from this trend. The U.S. response to this challenge has been to run even larger deficits. Defense spending, social programs, infrastructure, all require borrowing. The national debt explodes higher. At over $36 trillion and growing, U.S. national debt is reaching levels that make investors nervous. Can this debt ever be paid, or will it be inflated away? If the answer is inflation, precious metals become essential portfolio holdings. They're inflation hedges. They preserve purchasing power when currencies are debased. History proves this repeatedly. The debasement trade thesis is gaining mainstream acceptance, not just among gold bugs and conspiracy theorists, among serious institutional investors managing billions of dollars. When major institutional investors start allocating to precious metals, the price impacts are substantial. These are patient, long-term holders with deep pockets. They buy and hold for years. This creates a price floor. Institutional accumulation prevents major drawdowns. It provides stability that attracts more institutional capital, a virtuous cycle for precious metals investors. Now, let's be balanced. Every investment has risks. Silver is no exception. What could derail this bull market? What are the potential headwinds? A major global recession could reduce industrial demand temporarily. If EV sales collapse, if solar installations pause, if data center build-out slows, silver demand would suffer. However, the structural drivers would remain. Recession delays don't eliminate the electrification trend. They postpone it. Demand returns when the economy recovers, perhaps even stronger. Technological substitution is always a risk. What if someone invents a material that replaces silver in key applications? Copper alternatives, synthetic conductors, graphene breakthroughs. This risk seems low. Silver's properties are unique, its conductivity unmatched by affordable alternatives. Research into substitutes has been ongoing for decades with limited success. Government intervention could disrupt the market, price controls, export restrictions, strategic reserve releases. Governments have disrupted commodity markets before when prices surge too quickly. Such interventions typically fail long-term. They create shortages. They distort markets. They ultimately accelerate the very price increases they're trying to prevent. But short-term volatility increases. A strengthening dollar could pressure silver prices. If de-dollarization reverses, if the Fed aggressively raises rates, if global capital flees to dollar safety, silver could decline. But current policy trajectories suggest dollar strength is unlikely. Rate cuts are being discussed, deficits continue growing, de-dollarization accelerates, the dollar faces structural headwinds. Mining technology breakthroughs could unlock new supply. Advanced extraction techniques, economical deep-sea mining, asteroid mining in the distant future. More supply could pressure prices. These developments are years or decades away. In the near to medium term, supply constraints remain binding. Technology cannot quickly solve geology or geopolitics. So what does all this mean for you as an investor? How should you think about silver in your portfolio? What's the appropriate allocation? First, understand that silver is volatile. 155% gains sound amazing, but silver can also drop 30-40% in corrections. If you can't stomach volatility, silver may not be appropriate. Second, silver should be viewed as a long-term holding. This is a multi-decade structural story. Trying to trade in and out will likely result in missing the biggest moves. Third, consider both physical silver and silver mining stocks. Physical provides direct exposure. Mining stocks offer leverage to silver prices, but come with operational risks. Fourth, don't chase. Buying after a 155% rally feels uncomfortable, but if the repricing thesis is correct, current prices may still be early. Dollar cost averaging makes sense. Fifth, understand this isn't just about making money. Silver is portfolio insurance. It's protection against monetary debasement. It's a hedge against geopolitical instability. Sixth, stay informed about industrial demand trends. Watch EV sales data, monitor solar installation numbers, track AI infrastructure investment. These leading indicators signal silver demand. Seventh, pay attention to the gold to silver ratio. When it reaches extremes, mean reversion opportunities emerge. Understanding this relationship helps with tactical timing. Eighth, recognize that silver may be entering mainstream institutional portfolios. When pension funds and endowments allocate, the price impact could be enormous given limited supply. The smart money isn't ignoring this. Ray Dalio talks about the need for hard assets in portfolios. Stanley Druckenmiller has positioned for commodity strength. Legends are paying attention. The question is, are you going to act on this information? Or watch from the sidelines while a major repricing unfolds? Silver's 155% surge, a 50% rally in just 2 months. The second highest gold to silver ratio in history collapsing, industrial demand exploding, supply deficits widening, de-dollarization accelerating. These aren't random events. They're connected pieces of a larger puzzle. a puzzle that reveals a massive repricing of silver's value in the modern economy. The confluence is extraordinary. Technical positioning from stretched ratios, fundamental demand from electrification and AI, macro drivers from monetary debasement, all firing simultaneously. This is what perfect storms look like. When every factor aligns, when every catalyst triggers, when every trend reinforces, the resulting moves create generational wealth. The question isn't whether silver deserved to rally 155%. The question is, has it rallied enough? Or is this just the beginning of a much larger repricing? Given structural deficits, accelerating electrification, and ongoing de-dollarization, the case for sustained strength is compelling. This isn't a bubble. This is a revaluation of a critical industrial commodity. The world is changing, energy systems transforming, technology advancing, monetary systems shifting, and silver sits at the intersection of every major trend reshaping civilization. Those who understand what's happening and position accordingly will participate in this wealth transfer. Those who ignore the signals will watch from the sidelines with regret. This is your moment. The information is in front of you. The patterns are clear. The opportunity is present. What you do with it determines your financial future. The silver story isn't over. It's just beginning. Pay attention, stay informed, and position yourself for what's coming. Because, ready or not, the repricing continues.